Hello, I'm David Chaston with 90 at 9, brought to you by interest.co.nz. This week, get everything you need to know in 90 seconds at 9 o'clock with news of turmoil in bond markets. The day after the US Fed rate hike and their indication there may be as many as 3 more rate hikes in 2017, their CPI inflation release showed prices rising 1.7% per year and 2.1% excluding food and energy. This is the 4th consecutive rise in the US. And the US home building industry is in a confident mood, with their members reporting optimism at its highest level since mid-2005. The largest American banks will have to pay as much as $2 billion more per year to insure against a future market collapse. It's according to a newly adopted Fed rule designed to protect their financial system. The rule puts higher obligations on equity and bondholders to maintain their long-term exposure as the way to protect short-term depositors in the event of a failure. In fact, these big banks may need to raise as much as $70 billion more in capital to meet obligations under this rule. Interestingly, China is soon to be dethroned as the top holder of US government debt. China's foreign currency leakage, along with a weakening exchange rate, means that it is likely Japan will soon overtake it as the largest creditor of the US. Japan was last the largest in 2008, apart from one brief month in 2015. In fact, the US rate hike is ratcheting up pressure on the Chinese currency. The Chinese are nervous, with investors in yuan-backed securities getting decidedly skittish. Chinese authorities have halted trading in key bond futures for the first time as panicky investors dumped these securities on concern that their long-term credit-fueled bull market was coming to an end. In New York, the US Treasury 10-year yield has jumped to 2.59% on the Fed decision to go for a faster set of hikes. At one stage, it got up to 2.64%, but has since settled at a rate that is 10 basis points higher than the start of the week and 15 basis points higher than the start of the month. Markets knew a rate hike was coming and thought they'd priced it in, but what they're surprised about is the indication that 3 more hikes are likely in 2017. It has been estimated that the global bond market are now worth $1.5 trillion less now than they were after the sell-off began on the US election day. Given that global bond markets are worth more than $82 trillion and the US bond market's worth more than $31 trillion, it's still quite a fall in less than 40 days. Oil prices have fallen overnight by about $1 a barrel, now just under $51 for the US benchmark, while the Brent benchmark is now just under $54 a barrel. The gold price, however, has been absolutely hammered and is down a massive $39, now at $1,124 an ounce. And the New Zealand dollar is sharply lower as well against the greenback, now at 70.2 US cents. On the cross rates, it's holding its own though, at 95.6 Aussie cents, and against the euro at 67.6 euro cents. The TWI is at 77. I'm David Chaston. That was 90 at 9, brought to you by interest.co.nz.